America's RV market is crashing, and January 2026 is when it shows. Nothing looks wrong at first glance. Dealer lots are full, sale signs are up, but behind the scenes, confidence is gone. Dealers are slashing prices without advertising it. Lenders are stalling approvals, and factories are cutting production like demand isn't coming back. Here's why January matters. That's when inventory costs reset, financing pressure spikes, and unsold R-Vees turn from assets into anchors. When that happens, prices don't negotiate, they collapse. Used values are already falling faster than new ones. Trade-ins aren't clearing. Some brands are quietly vanishing from dealer lineups entirely. And once you see the 5 signs lining up right now, you'll understand why waiting could save you thousands. What's happening? There is a moment in every broken market when prices stop being defended and start being abandoned. You can feel it when you walk a dealer lot. The tags change, the tone changes, the confidence disappears. That moment has arrived for 2024 and 2025 RV inventory. And the reason is not generosity, it is math. Here is what is actually happening. Most RV dealers do not own the units sitting on their lots. Those units are financed through floor plan loans. That is short-term inventory financing tied directly to interest rates. Right now, those rates are hovering between 7% and 9% annually. On a travel trailer with a sticker price around $75,000, that interest alone can cost a dealer more than $500 every single month. Not insurance, not staffing, just interest. Now multiply that by 40 units, or 60, or 100. That is when the clock starts working against them. This is why you are seeing brand new 2020 and 5 travel trailers listed for prices that look wrong. I am talking about listings that once showed $84,995 now crossed out and replaced with $62,900. Same vehicle identification number, same build sheet, no upgrades, no changes. Just pressure. You can see this clearly on recreational vehicle trader listings and dealer websites that show price history. The cuts are not subtle. They are not seasonal. They are not tied to incentives. They are defensive moves to stop the bleeding before the year ends. And here is the part most people miss. Dealers are not trying to make money on these units anymore. They are trying to stop losing it. As the calendar moves closer to January, 2 things happen at the same time. Inventory taxes reset, and floor plan agreements get reviewed. Unsold inventory becomes more expensive overnight. That forces decisions. Either cut the price now or carry a heavier burden later. Most choose the first option. This is why near-cost pricing is appearing quietly, without banners or announcements. Dealers do not want to advertise desperation. They want the units gone, fast, clean, quiet. What does this mean for your wallet? It means the pricing you see right now is not the bottom, it is the first crack. When a dealer is willing to break even in November, January becomes about liquidation. That is when discounts stop being negotiable and start being automatic. There is another layer here. Manufacturers are watching this too. When dealers cannot move current year inventory, manufacturers lose leverage. Incentive programs increase. Wholesale pricing gets adjusted. The pressure flows downhill, and it always lands on the sticker. This is not about panic. It is about timing. Dealers over-ordered during the boom. Demand cooled faster than expected. Interest stayed high. Those 3 forces collide on the lot, not in a boardroom. If you are seeing a 2025 unit priced like a used one, that is not a gift. It is a signal. The market has shifted, and the people holding inventory know it. The key is patience. Near cost today becomes below cost later, especially when January inventory counts hit paper. And this is only the first sign, because once financing tightens and used values fall, this pressure multiplies fast. Now watch what happens next, because when lenders start pulling back, the entire pricing structure starts to bend. RV loan approvals, quietly tightening. Nothing freezes a market faster than silence from the lender. Not a rejection letter, not a headline, silence. That is exactly what is happening right now inside RV financing offices across the country, and it is reshaping prices in a way most people do not notice until it is too late. During the boom years, approvals were loose, terms stretched out to 20 years, down payments were thin, credit standards were relaxed quietly because lenders believed values would hold. That belief has changed, not publicly, privately. And private changes are the ones that hit hardest. Here's the first shift. Loan terms are shrinking. What used to be standard 20-year financing is now being capped closer to 12 or 15 years, depending on the lender and the unit. Shorter terms mean higher monthly payments. Higher payments disqualify buyers who looked fine on paper just months ago. Next comes the down payment. Where 5% used to pass, 10 or 15% is now being required on many approvals. That is not a small adjustment. On a $70,000 travel trailer, that is an extra $7,000 up front. Many deals stop right there. Now add interest. Current R-Vee loan rates are hovering between 7% and 9%. Even for well-qualified borrowers. That pushes monthly payments into territory that feels uncomfortable fast. Buyers hesitate. Hesitation kills deals. This tightening is not random. It is driven by performance data. Loans written during 2021 and 2022 are starting to show stress. Delinquencies are rising, not exploding, rising. Enough to make lenders cautious again. Dealers see this before anyone else. Finance managers notice more conditional approvals, more follow-up questions, more last-minute declines. The buyer does not hear no immediately. They hear, let us review it. That delay matters. Here is the proof. Dealer finance departments are reporting approval rates down by double-digit percentages compared to last year. Not because buyers vanished, because lenders changed the rules quietly. What does this mean for pricing? Simple math. Fewer approved buyers equals fewer offers. Fewer offers force sellers to lower prices. This pressure does not show up overnight. It builds week by week, deal by deal. This is why you are seeing R-Vee listings sit longer, even when prices are cut. Financing friction slows everything. Inventory backs up. Dealers respond the only way they can. Price. There is another angle. Banks do not want long-term exposure right now. They want shorter risk windows. That means less flexibility, fewer exceptions, and more conservative valuations. Some lenders are even capping loan amounts below sticker prices, forcing buyers to cover the gap in cash. That gap is deadly for demand. When buyers cannot bridge it, they walk. When enough buyers walk, the market resets downward. Timing matters here. January is when lending models refresh. Risk assessments update. Portfolio performance gets reviewed. If current trends continue, approvals will tighten further before they loosen. That creates a narrow window. Prices fall first. Credit eases later. Those two rarely move together. If financing is getting harder while prices are still falling, patience protects your money. Buying into a tightening credit environment locks in risk. This is not fear, it is sequence. Credit leads. Prices follow. And once this pressure meets factory cutbacks, the market enters a completely different phase. That phase is slower, quieter, and unforgiving. Deals fall apart late. Appraisals come in low. Cash buyers gain leverage without trying. Sellers lose patience. Dealers lose margin. Lenders protect themselves first. The order never changes. Watching credit is watching the future. And right now, credit is sending a warning most people have not learned to read yet. That is why the next shift will catch many off guard when approvals suddenly vanish completely across the country quietly. If this breakdown is helping you see what's really happening, hit like so more people see it. Subscribe for updates as this market shifts, and share your thoughts below, because real experiences add context that listings and headlines never show. Factory production cuts turning permanent. At first, it sounded harmless, a pause, a slowdown, a temporary adjustment to balance supply. That language was everywhere when R-Vee factories first eased off the throttle. But time has a way of revealing intent, and time has now exposed the truth. These cuts are no longer seasonal, they are structural. During the boom, factories expanded fast. Second shifts appeared overnight. Temporary labor filled lines. Output exploded to meet demand that felt endless. Now that demand is gone, and the machinery of production cannot stop quietly. It grinds, it resists, then it snaps. Here is what changed. R-Vee manufacturers reduced output by roughly 30 to 45% compared to peak years. That number matters because seasonal slowdowns are measured in single digits. Double-digit reductions mean something broke. You can see it in the Midwest. Plants that once ran lights-on schedules are dark by mid-afternoon. Parking lots, once full of worker trucks, now show empty rows. Layoffs labeled temporary in early 2025 have quietly become permanent. This is not about efficiency, it is about survival. Factories produce units to feed dealer networks. When dealers stop ordering, factories choke. Inventory piles up at distribution yards. Finished units sit waiting for buyers who never arrive. Carrying costs climb. Materials age. Labor becomes excess. The proof is visible. Industry shipment reports show sustained declines month after month, not rebounds. Plant notices posted to local communities confirm shift eliminations with no return dates. This is not a blip. Why does this matter to pricing? Because factories cannot sit still. When production slows this hard, manufacturers push pressure downstream. Dealer incentives increase. Wholesale pricing softens. Target volumes get adjusted lower, then lower again. Manufacturers do not like discounting. It cheapens brands, but they dislike idle factories more. When output drops this far, protecting pricing becomes secondary to keeping lines moving. This is where forced discounting begins, not at the retail desk, at the production level. If factories cannot move volume through normal channels, they lean on dealers. Dealers lean on prices. Prices fall. There is also a quality angle few talk about. When factories lose experienced workers, consistency suffers, rehires are slower, training costs rise. That uncertainty makes manufacturers even more cautious about ramping back up, so they choose the safer option: produce less, clear backlog, accept lower margins. For the market, this creates a lag effect. Production cuts today show up as price drops months later. By the time buyers notice headlines, inventory has already been marked down behind the scenes. This is why factory cuts turning permanent matter more than any advertisement. They signal a long reset, not a quick correction. If you are watching timing, watch production schedules. They tell the truth before pricing does. And once reduced production collides with collapsing used values, the market enters its final phase of adjustment, where prices stop resisting gravity and simply follow it downward into the next chapter quietly. This matters because production discipline shapes future pricing power. When factories retreat, they rarely rush back. Restarting lines cost money. Rehiring skilled labor takes time. Suppliers demand higher guarantees. All of that slows recovery. In the meantime, excess inventory keeps leaking into the market. Dealers keep trimming. Buyers keep waiting. That waiting reinforces the decline. The system feeds itself. Understanding this sequence protects your timing. It explains why patience works here. The slowdown is not ending. It is settling in. Once this reality sets in, pricing narratives collapse. Sales tactics lose effect. And only math remains guiding decisions. Slowly, predictably, and without mercy for anyone ignoring the signals already visible across the entire R-Vee industry. Used R-Vee values. Falling faster than new prices, used values are always the first to tell the truth. They move without marketing. They react without permission. And right now, they are dropping faster than most people are willing to admit, pulling the entire R-Vee market down behind them. Here's the quiet shift. Owners who bought during the peak are now underwater, not slightly, deeply. Units purchased in 2021 and 2022 at inflated prices are worth far less today, and many owners know it. That realization triggers behavior, and behavior moves markets. The first reaction is denial. The second is urgency. Owners start listing earlier than planned. Not because they want to sell, but because they want to escape before values fall further. That is how supply builds silently. You can see this clearly at auctions. Late model used R-Vee units are arriving in larger volumes, often with low mileage and clean condition. These are not worn-out rigs. These are exits, and exits come with discounts. Here is a concrete example: a 2023 fifth wheel with an original invoice near $78,000 is now clearing auctions in the range of $49,000 to $52,000. Some are not clearing at all. They fail to meet reserve and roll to the next sale. That gap matters. That gap rewrites expectations. Once used, pricing resets lower. New pricing loses its anchor. Dealers rely on trade-ins to make new deals work. When trade and values collapse, buyers cannot bridge the gap. Deals stall. Inventory builds, prices bend. This is why used values always fall first. They are unprotected. There are no incentives, no manufacturer support, no brand messaging, just supply meeting demand in real time. Another layer here is loan performance. Many used units still carry loans written during peak pricing. When owners discover the payoff exceeds market value, panic sets in. Some walk away, some sell at a loss. Either way, more inventory hits the market. You can track this through private listings as well. Classified platforms show increasing days on market. Price reductions appear weekly. Sellers test high, then cut again. That pattern repeats until the unit moves or disappears. The important part is speed. Used values are adjusting faster than new values because they have to. There is no buffer, no floor, no patience. For the broader market, this creates downward gravity. New units cannot stay priced above used alternatives for long. Buyers compare. They always do. When a lightly used unit undercuts a new one by $20,000 or more, the new price becomes impossible to defend. This is when manufacturers and dealers face hard choices: support pricing and lose volume, or move inventory and accept lower margins. In this phase, volume usually wins. Used value collapse also damages confidence. Buyers hesitate when they see rapid depreciation. Hesitation slows demand. Slower demand forces deeper cuts. The loop tightens. Timing matters here. Used values tend to fall in waves. The first wave is owners exiting early. The second wave is forced selling. The third wave is capitulation. Each wave pushes pricing lower than expected. Right now, the market is between the first and second wave. That is why the drops feel sudden but incomplete. More supply is coming. This matters because once used values reset fully, new prices follow quickly, not gradually, quickly. If you are watching the market, watch used listings. They lead everything. They show where pricing is headed before it arrives. And when collapsing, used values collide with dealers dropping brands. The final piece of the puzzle locks into place. That is where the next shift begins. Quietly, decisively, and without recovery bounce. That final signal is already forming, and once it becomes visible, the remaining price resistance disappears almost overnight. If you want clear, data-backed updates as this market continues unfolding into January, subscribe now so you don't miss what changes next, which brands lose support, and when timing finally flips from risk to real opportunity. Dealers quietly dropping entire R-Vee brands. Watch a dealer lot long enough, and you will notice something missing. Not a model, not a trim, a name. One that used to sit front and center is suddenly gone, replaced without explanation. That silence is not accidental. It is the loudest warning in the entire R-Vee market. Dealers do not announce this. They never will. Brands are not dropped with press releases. They are removed quietly, after months of internal math, warranty headaches, and resale damage. By the time customers notice, the decision was made long ago. Here is the real reason this matters. When a dealer drops a R-Vee brand, support collapses first. Parts access slows. Warranty approvals get harder. Trade-in offers shrink. Resale confidence disappears. Price follows all of it downward. This is already happening. Dealers are trimming lineups ahead of January contract resets. That timing matters. January is when floor space is renegotiated. It is when allocation commitments renew. It is when underperforming brands get cut loose. The proof lives in ordering behavior. Reduced allocations, canceled shipments, fewer units requested for 2026. These signals never appear in advertisements. They show up in what dealers stop ordering. Why does a dealer do this? 3 reasons: slow turnover, high warranty cost, weak resale protection. When a unit sits too long, interest eats margin. When warranty claims stack up, service bays clog. When resale drops, buyers hesitate. Together, they poison profitability. Once that happens, the brand becomes a liability. Dealers cannot afford liabilities right now. Carrying costs are too high. Credit is tighter. Inventory risk is punished, not rewarded. Here is the financial impact. A brand without dealer support loses value fast. Buyers worry about service. Lenders lower appraisals. Insurance valuations soften. That combination destroys resale. You can see it when listings disappear. A unit that once appeared at multiple locations now shows up at one, then none. The inventory did not sell. It was pulled. Manufacturers fight this quietly. Incentives increase. Wholesale pricing bends. But once trust breaks, it rarely returns quickly. This is why brand exits accelerate downturns. They remove safety nets. They turn ownership into risk. Buyers sense that immediately. Timing matters again. Dealers drop brands before prices collapse publicly. That is how they protect themselves. By the time discounts appear, support is already fading. If a brand is losing shelf space, its pricing future is sealed. No marketing can fix that. No rebate can reverse it. This is the final signal because it locks in everything before it. Credit tightening, used value collapse, factory cutbacks, all of it converges here. When brands disappear quietly, the market stops pretending, prices stop resisting, the reset completes. That is why this matters more than any sale sign. It tells you which names will survive and which ones will be remembered only in listings that no longer load. Pay attention to service bays. When a brand fades, technicians stop training on it. Parts catalogs shrink. Repair times stretch. That affects ownership costs immediately. Insurance companies notice too. They adjust values downward when support weakens. Lenders follow with lower appraisals. That ripple hits everyone holding the keys. This is why exits happen quietly. Noise invites questions. Silence avoids liability. By the time price tags fall sharply, the foundation already cracked. Watching dealer lineups protects you from that trap. If a name is missing, ask why. The answer is never comfort, it is cost. And cost always moves downhill next. Once confidence breaks, it never returns evenly. Some brands vanish completely, others limp forward. Either way, pricing suffers, support thins. Ownership risk rises. That is the final math. Knowing this early keeps you ahead of the reset. That awareness alone can save real money later. Timing patience here becomes protection instead of regret when markets finally settle for most owners. Here's the reality. Markets don't crash loudly. They weaken quietly, then reset all at once. That's what you're watching unfold right now. Inventory pressure, tightening credit, falling used values, factory pullbacks, and disappearing brands are not opinions. They're signals. Timing matters more than excitement. Patience beats urgency. And waiting can protect more money than rushing ever will. The next few months decide who absorbs the loss and who sidesteps it. If you're shopping, selling, or watching R-Vee prices right now, I want to hear what you're seeing on dealer lots and listings. Leave a comment below. If this video gave you clarity, hit like, subscribe for ongoing updates, and stick around.